There's a moment that hits a lot of Canadians somewhere in their 40s or 50s. It usually happens at the kitchen table, looking at a statement, doing the math, and realizing the number staring back is not going to be enough. And the worst part isn't the number itself. It's the understanding that this didn't have to happen. The market wasn't the problem. The economy wasn't really the problem either. The problem was a handful of investing truths nobody bothered to explain when there was still time to act on them. So before that moment finds you, let's go through 7 of them, because every single one of these has the power to change the next 20 or 30 years of your financial life. The first truth is that most Canadians dramatically underestimate how much they actually need. A recent survey from CPP Investments showed that Canadians now believe they need around $900,000 to retire comfortably, up from $700,000 just a year earlier. That's a 30% jump in expectations in 12 months, and it's happening because the cost of groceries, rent, and basic living has shifted in a way the old retirement math never accounted for. Meanwhile, the median RRSP balance for Canadians aged 55 to 64 sits well under $200,000. There is a gap there, and it is enormous. If nobody shows you that gap early, you spend your best earning years thinking you're on track when you're actually drifting further behind every month. And the average CPP payment for new retirees at 65 is around $900 a month, while the maximum sits closer to $1,500. Add OAS on top of that, and you're still looking at an income that, for most people, won't come close to covering the lifestyle they imagined. The number you actually need depends on the life you want. Sit down, estimate your real monthly costs in retirement, multiply that by 12, and then by 25. That's a rough version of the number you're actually working toward, and it's usually the first time people see the gap with their own eyes. The second truth is that time is doing far more work than you realize, and most people only understand this once they've already wasted a decade of it. If you invest $300 a month starting at 25 and earn an average return of 7%, you end up with roughly $720,000 by age 65. Start that same $300 a month at 40, and you end up with around $245,000. Compounding doesn't reward intelligence. It rewards patience and an early start. And the moment you stop waiting for the perfect time to begin is the moment your future self starts thanking you. The third truth is that the TFSA is the most misunderstood account in the country. In 2026, the contribution limit is $7,000, and the total cumulative room for someone who has been eligible since 2009 is now $102,000. Most Canadians treat the TFSA like a fancy savings account, parking cash in it and earning 2 or 3% interest. But the real power of the TFSA is when it holds growth investments. Every dollar of gain inside that account is tax-free for life. Withdrawals are tax-free. It doesn't affect your OAS clawback in retirement. If you had simply maxed out your TFSA every year since 2009 with broad market index funds, you would likely be sitting on well over $200,000 right now, completely shielded from the CRA. The fix is simple. Open a self-directed TFSA at a discount brokerage, hold a diversified ETF inside it, and let the account do what it was actually designed to do. The fourth truth is that the RRSP is not just a tax refund tool. A lot of Canadians contribute in February, get the refund, spend it, and feel like they've done their part. The 2026 RRSP contribution limit is 18% of your earned income up to a maximum of $33,810. But the real strategy is what you do with the refund. If you reinvest it, either back into the RRSP or into your TFSA, you turn a one-time tax break into a long-term compounding engine. There's also the question of when to use the RRSP at all. If you're in a lower tax bracket right now, the TFSA might serve you better first. The RRSP rewards people who will be in a lower bracket in retirement than they are today. There's also the Home Buyers Plan and the Lifelong Learning Plan, 2 features of the RRSP that let you borrow from yourself without penalty under specific conditions. And most Canadians have no idea those tools even exist until they need them, and it's too late to plan around them properly. The fifth truth is that fees are eating your retirement, and the numbers are worse than most Canadians want to believe. Canada has historically had some of the highest mutual fund fees in the developed world. A management expense ratio of 2% sounds harmless, but over 30 years, a 2% fee can consume close to 40% of your final portfolio value compared to a low-cost index fund charging 0.05 to 0.25%. The shift toward low-cost ETFs from providers available in Canada has been one of the biggest gifts to retail investors in a generation, and the people who ignore it are paying for someone else's lifestyle with their own retirement. The hard part is that these fees never show up as a line item on your statement. They're baked into the returns, taken before you see anything, which is exactly why so many people never notice until they finally compare what they have to what they could have had. The sixth truth is that trying to time the market will cost you more than any crash ever will. The Bank of Canada has held its policy rate at 2.25% through most of 2026, and every few weeks you hear someone on the news predicting the next big move. Studies looking at the last 20 years consistently show that missing just the 10 best days in the market can cut your total return roughly in half. And those 10 best days almost always happen in the middle of the scariest stretches, when most people have already pulled their money out. The market doesn't ring a bell at the bottom. It just goes, and the people who stayed invested are the ones who got carried up with it. Boring, automatic, consistent investing beats clever timing almost every single time. Setting up an automatic transfer the day after payday removes the emotion from the entire process. And emotion is the single most expensive thing a retail investor brings to the table. The seventh truth, and this is the one that hurts the most, is that lifestyle inflation is the real reason most Canadians don't build wealth. It's not the income, it's not the tax system. It's the fact that every raise, every bonus, every side hustle dollar gets absorbed into a nicer car, a bigger place, a more expensive version of the same life. The Canadians who build real wealth treat every raise as two events, a small lifestyle bump and a permanent increase in their investment contribution. That single habit, repeated over 20 years, is what separates the people who retire on their own terms from the people who keep working because they have to. A useful rule a lot of people follow is the 50-50 raise split. Half of every raise goes to lifestyle, and the other half goes straight into investments before it ever touches your checking account. The reason this works is that you never feel the sacrifice. Your take-home pay still goes up, your lifestyle still improves, but a parallel version of your wealth is being built in the background. So here's where it all lands. The investing truths most Canadians find out too late are not complicated. They're not hidden behind some secret strategy or a private fund nobody can access. They are the basics, applied early, applied consistently, and protected from the two things that destroy most portfolios, which are high fees and emotional decisions. You have the TFSA, you have the RRSP, you have the FHSA if you're saving for a first home, with $8,000 a year in room and a $40,000 lifetime cap that combines the tax deduction of an RRSP with the tax-free growth of a TFSA. The tools are sitting right in front of you. The only question is whether you'll use them now or find out about them the hard way 20 years from now. The difference between those two paths is not luck, and it's not income. It's the decision to start, and then the discipline to keep going when the market gets loud and your friends start chasing the next shiny thing. If this gave you even one idea worth acting on, do me a favor and hit the like button, subscribe to this channel, and turn on notifications so you don't miss the next one. I'll see you there.